Test.
Hey. Hey. Okay, it works. It works. We're good. We're good. Hello, everybody. Thank you, Cindy, for the introduction. Thanks for coming. My name is Fully,
I'm Indigo.
and we're here to talk about Baseline Protocol today. Okay, so Baseline Protocol is a new kind of like market-making system that we've tried to design to democratize liquidity and trading on-chain. The main premise behind it is that instead of having to work with third-party market makers or service providers when dealing with your token listing and trading, we wanted to create a protocol that allows anyone to deploy a new ERC20 with liquidity and tokenomics kind of built in from scratch. Okay, so what does that mean? Baseline is a market maker, but not everyone is very familiar with what market makers do. So market makers basically are market participants that trade assets, buy and sell assets, and make trading easier for different market participants. What they do is if you need to sell or you need to buy a token, there's always someone on the other side that's willing to make the trade with you for a good price. So if you don't have a market maker for your token, you don't have liquidity. Anytime someone spends a small amount of money buying the token, or if they sell a small amount of the token, you see the charts kind of go crazy. And that's because there's nobody in the middle servicing the trade. So what we're trying to do is we're trying to find a more decentralized and permissionless way to facilitate that for everybody. Okay, so why do we decide to do this? Market making is actually a very complicated and difficult issue that we have to deal with in crypto today. Right now, I think the biggest problem is with the traditional model. There's a lot of incentive misalignment and a lot of problems that come with this. So going back, yeah. So the first thing is that market makers, when you work with a market maker as a token project, the incentives of the partners that you're working with aren't necessarily aligned with the incentive of the token holders and the team. In order to make money as a market maker, you have to be extractive in the market. Basically, you have to be profitable trading. If you're not profitable trading as a market maker, you're going out of business. But if you are profitable trading as a market maker, then you're taking money out of the markets from other holders or people, and you see the value of the tokens slowly going down, and liquidity, net liquidity that comes in and out slowly move out of the market. The second thing about working with a market maker as a firm or a company is that you have to trust that they're going to do what they say they do. So if you're a protocol founder, you want to launch a token, you work out a deal with one of these firms, you have to hope that they are going to buy the token and sell the token under the predefined terms. And for a lot of people who've worked with market makers before, that's not always the case. They don't necessarily provide liquidity when they say they will, and it causes a lot of problems. And so the third piece is that in order for these liquidity deals to happen under the traditional model of token economics, you have to give your market makers a large percentage of your initial supply. So, you mint all the tokens, maybe you give 10% of all the tokens to the market makers. They go to an exchange, they start selling your tokens immediately. And the problem with this is that one entity basically has control over all your tokens. They decide when they want to sell it, when they don't want to sell it. They decide when they come, and buy it back, and it gives them a very big advantage for everyone who's trying to trade your token. So at the end of the day, you have this very imbalanced market where the guy who owns, all of the supply is actually incentivized to extract as much value as they can, providing liquidity in your market because, they have to pay for their offices, for their salaries, they have to grow their company. And so, all of this ends up with what we have today, which are, a lot of tokens with a lot of really bad deals, and listings are very expensive, and things end up kind of trending down only over time as liquidity is kind of leaving the markets. Yeah.
So that brings us next to automated market makers. So as we do in crypto, we generally replace old financial institutions with things that can be automated and are permissionless. So in our case, for market makers, we've created things called automated market makers. And you know these popular protocols like Uniswap. So what these are very simple market makers that make it permissionless and open for anyone to be able to be market makers for tokens. They can provide liquidity as they please. There's other systems that we've identified that we call automated liquidity systems that are smart contracts built on top of automated market makers. These are less known, but they're designed to replace the need for traditional market makers in that they can buy and sell tokens for certain protocols or teams. What's nice about these automated liquidity systems is they don't really have the incentive alignment problem, as they're just programmed to do as they are, they're just programmed to make fees as they do, and they're built to the benefit of the token holders generally. They don't have a need to make money, pay salaries, anything like that. They're also guaranteed to perform the way they're programmed to be. You don't have to worry that they're gonna dump on you or whatever, which sometimes is the case. So some useful properties of these automated liquidity systems are that they're deterministic and that you know exactly what they're going to do. They're non-extractive, so they don't have to make money for themselves. They can use any fees and revenues that they generate for the benefit of token holders or the protocol itself. They're also transparent and auditable, so you're not really worried. You can always check on chain what the code is doing. And they're designed to act as the primary market makers for the tokens to replace the traditional market makers. And last, I think this is a really important point actually, is they act as guarantees for market participants. So since everybody knows the rules of the market, they're able to, you as a trader, as a holder, or as a liquidity provider yourself, you're able to design your strategies around that, which is, I think, very, very important. And I think many people don't really think about this until you kind of see these systems in action. So some examples that are out there are my personal favorite, Olympus Range-Bound Stability, or RBS. RBS is designed to buy and sell and market make the Ohm token fully on chain. And what it does is it keeps the price of Ohm within a certain range. But it still allows the market to break through this range if there's enough buy or sell pressure. So what it kind of does is just supports the market and what it's trying to do rather than keep it at a peg or anything like that. Another good example that many people don't really know about is White Lotus, which has been a big inspiration for us. So White Lotus was a small project in 2023, like in the trough of the bear market. White Lotus was a system built on top of a concentrated liquidity pool, which what it did, it concentrated all of the reserves in the pool, so all the ETH into one certain price. So it was designed to be able to absorb the entire circulating supply as a floor price. So if everybody dumped their token all at once, they would be guaranteed this floor price, no matter what. And you'll see this was like a huge inspiration for us at Baseline. And last, something a little bit different is the Frax AMOs, or algorithmic market operations. These things many people don't really know about, but this is how Frax maintains their peg at $1. Frax is a stablecoin, by the way. So Frax, what it does, it allows these smart contracts to mint and burn Frax into their liquidity pool to maintain the price at $1 at all times. There's also a lot of other systems like this. I don't think it's been talked about a lot in crypto, but that would be like a whole nother presentation on its own, maybe for later.
Yeah. Okay, so that leads us to Baseline. So as Indigo is saying, automated liquidity systems basically replace market makers with smart contracts that do the buying and selling as your token counterparty for you. And so at Baseline, we kind of took the inspirations from a lot of the other designs that we've seen, and we've consolidated it into one simplified system that is built around a Uniswap v3 concentrated liquidity pool. So what that means is we're trying to do all of the things that we've seen from the previous systems, from White Lotus, from Olympus RBS, from Frax AMOs, and we do that all in these concentrated liquidity positions directly on chain that you can see. And we'll go into a couple of those mechanics in a little bit. Yeah. Okay, so the three main components of baseline that I think are important to understand. One is called the baseline value. The first one is baseline value. The baseline value is the minimum price at which any baseline token can be sold forever. And this is always guaranteed. The liquidity to buy back that token will exist in the Uniswap pool. It's immutable and you can't touch it. So no one can take it out or move it. We can't do anything with it, even as like the team or the devs. So it's there forever. And it's enforced through the market making system. And so what the market making system does is it takes a concentrated position in Uniswap and it looks at, okay, can this position, if every single token in circulation today was sold at the same time, can this position still buy back all of those tokens and have a little bit of ETH left over? And we do calculations in the smart contract to move this position around so that this is always the case. So no matter what, if everyone sells everything tomorrow, the baseline value is the price that the last token will be sold at. The first token will probably be sold at the market price, and then as the price goes down and down and down and down, you'll see the minimum price is the baseline value, and that's where it's at.
One more thing. The baseline value is also designed to only go up. So whatever the price is at initially is that we actually calculate it on chain such that all the fees and everything that we generate make this baseline value to either stay the same or increase over time. It will never go down.
Do you want to talk about the credit facility?
Sure. So the credit facility is designed, so since every token has a BLV behind it, such that commonly it's just a value of ETH that every token is backed by, you normally wouldn't want to sell your token to be able to access that floor price, that BLV. So what we allow you to do is actually borrow this BLV at any time. And what we do is we actually allow you to do it in a non-liquidatable fixed rate and fixed term loan. So you can take this at any time, and
with no Oracle.
With no oracles, by the way. There's
Oracle-less, non-liquidatable lending.
Yes, it's pretty cool. So yeah, you can take this amount, or you can take this BLV at any time. And what's nice about is that normally when you hold a token, you usually have to you're either thinking of buying or selling, and sometimes you can stake it or do something like that. This gives a native utility to the token as an alternative. And I'll show you later the effect of this on the price charts. It's very interesting. But what a lot of people do is they'll buy the token and then they collateralize it and borrow the BLV, and they often loop it back in. So they take the BLV and they buy back the token to get leverage exposure to the price increases. But they can also take the BLV and stake it into a lending protocol, or you can provide liquidity on a separate market. You could do whatever you want with it. So it just gives a lot of native utility to the token.
Yeah, so I just want to add a little detail here. So one of the reasons why the lending can be non-liquidatable and Oracle-less is because the protocol basically has the guarantee of the BLV. So when you're taking the minimum value of it, where the money is actually coming from for your loan is coming from the Uniswap pool directly. So the protocol normally has this ETH sitting in the pool that's reserved to buy back your token at that price. As soon as you collateralize it with the protocol, it realizes that it doesn't need that ETH to sit there because it now owns the token that you would have to sell. Because the protocol has the token, it can give you the ETH ahead of time by pulling it directly from the Uniswap pool and letting you use it for whatever you want. So as Indigo was saying, a lot of people are trying this mechanism in different ways. Some people just go gig along on baseline tokens by borrowing the ETH of the pool, and then they put it back in. And people have called this looping. So you just kind of borrow, buy, borrow, buy, borrow, buy, borrow, buy. And it depends on the difference of the current price to the price that you're getting the loan, how many times you can do this efficiently. But it's really cool to see that at launch from day one, when we made a token, people are able to borrow and leverage directly inside the Uniswap pool. You don't need a perp integration, you don't need anything, and you already get a lot of exposure.
It's also guaranteed to be solvent because there's no liquidations. We just default the loans if they don't pay back, and everything actually stays solvent in the end.
Yeah.
And lastly, like all the interest and everything that gets paid to this credit facility goes to increasing the BLV for everybody.
Cool. Okay. Yeah. I mean, okay. So both of these mechanics work in different ways to accrue value to the baseline value. And I guess the reason why we even kind of like went down this path is because Indigo and I are both like notoriously not great traders. We really like to believe in the projects that we invest in and buy. And the way crypto works today, in my mind, is it really incentivizes and rewards impatience and profit taking because the structure of your crypto tokens, the markets are very thin in terms of liquidity. So the first people that capture it actually take all the upside. But that's not very good in my mind if we have a community of people who want to believe in the things that they're buying and holding. And so the mechanic to kind of reward that is to take the surpluses and fees that are happening in these pools and moving them into a minimum value so that people who are holders, people who are patient, people who don't want to just like trade their token for quick profits, they have other alternatives and value accrual mechanisms built directly into the tokenomics. So you're not kind of trying to fight and figure out where your entries are and where your exits are and time everything perfectly. So this is one way that we've tried to find how to give more advantages to passive holding and patience as opposed to just active trading and balance out the dynamics a little bit there. Yeah. Sure. Okay. So baseline protocol. So we're kind of associated with two things. One is the protocol, which is called Baseline, but we launched a token on this protocol called Yes. So Yes Money 420 is the Twitter handle. There's been a lot of hype around it on Blast, actually. So we launched on March 3rd, and this is the first of many tokens that we plan on launching on Baseline. We think that there's no perfect or optimal liquidity structure or market making strategy. Different tokens will want different structures. Yes is the first of many to come. It's right now the most liquid pair on Blast. Something really cool is we did $300 million of volume in the first 48 hours of launch. We've reached over $500 million of volume on Blast. We're over 30% of all total volume traded on the L2 right now. So it's been a pretty crazy ride. Yeah.
All right. I would normally not put a price chart on a technical presentation, but it's pretty interesting. Relevant. So I just wanted to show you guys. So we didn't, as we designed the system, we worked on it for like almost a year, and we tried to explain to people, but nobody really believed that what we were saying was possible, or that it was, or they didn't really think it was significant at all. So rather than try to like keep explaining to people, we'd rather just launch a token, make a cool meme or like a funny meme, and then just let's just show people what it can do, right? So this is why I show it up here. So you can see the green price right here. Let me move my laptop. You can see the green line right here. This is actually the BLV. And I know everyone, when I said BLV only stays or goes up, no one believed me, but this is actually what it's doing. So some interesting things, as you can see. One interesting thing is that because we have this alternative to buying and selling, you can like borrow and do something else with it. There's actually a lot, you can't really like use technical analysis or something on this chart. It just looks so weird. And I don't think I've ever seen anything like it before. So you can see at the front, holders would rather actually borrow than sell. And this is why we get these humongous green movements up here, because everyone's just very degenerate, especially if you don't liquidate their loans. So that's what's happening right here. And then what's interesting is that people, as they loop, as they borrow and then rebuy the token, you're actually getting multiples of exposure on your BLV increase. So if you loop however many times and you get like 3x exposure, the BLV increase is 2%, you're actually going to get 6% on your BLV increase.
Hold on, let me jump in real quick. For context, one of the coolest things actually about the lending system is, so we're lending always what the green line is against one yes token. When that green line goes up, you can actually borrow more ETH for no extra collateral. So when we launched, someone put in a couple yes tokens, and then they waited maybe an hour or two later, and they asked me, hey, Fully, is there a bug? I'm pulling ETH out of the system, but I didn't buy more yes. And the answer is no, there's no bug. Actually, the system is working as intended. What's happening is that your guaranteed value of the token is increasing, and the system is able to provision more ETH for your borrow. So the dynamic that Indigo is talking about is for all of the people that actually looped, they borrowed and bought and borrowed and bought, and they're like 4 or 5 times levered. When the floor price is going up, they're actually borrowing 4 or 5 times the floor price value against the original money they put in. And this is kind of like a very crazy dynamic that we haven't really seen before. And the other thing that's really funny is now every time when the floor goes up, you see a lot of bids come in as capital gets unlocked in the system and the risk is being repriced.
You can see it. Like every time the BLV increases, there's like humongous green candles.
Like that little yeah.
And so it's really interesting to see. The other thing is, I got a lot of bug reports about that. People are like, oh, your lending system broke. It's giving me free money. And it's like, no, that's just how the system works. Okay, so another really interesting thing is like because how much of the supply is actually collateralized, even though the BLV is like a hard floor on the price, there's kind of like this effective floor. And the guys at Ajna actually told us this, that they were intending to actually lend at a price higher than our BLV. So it's just a cool property of the system. And then lastly, what I think is really interesting is, so anyone who looped where they like leveraged and bought under the current BLV, they have very little incentive to sell. What they do is like they usually just sit on their loan and they just, every time the shift happens, like they just get their increases in the BLV and they're just happy sitting in the loan.
Yeah, so I think like one of the most interesting dynamics about this is in a baseline type market, the risk and reward is much more transparent to traders. If you're buying a token, so first things to consider, one is we don't have any external supply from the beginning. So there's no tokens that go to the team, there's no tokens that go to advisors or investors. Everything that's ever bought is basically bought from the pool, and the money that's used to buy the token goes inside. And the second thing is because you have this like much more fair supply dynamic, and you have like a risk that's defined. You can choose what your risk trade-off is. You don't have to guess, oh, is it going to fall to this price or that price? So unlike most tokens, you have a reverse incentive to sell as the price goes down. Because when the price is going down, the amount that you have left to lose continues to go down. So now you have a trade-off. If you don't want to stay in the asset, you can still exit at very, very deep liquidity. But if you believe in it, you also have opportunities to double down. And because of that, and because of the leverage that comes from the credit facility, what Indigo is saying is the prices will get closer and closer to the premium. That gives more people leverage and more incentive to buy it. And so, you have counter-cyclical incentives that are at play.
One last thing. I only talked about like people buying. I also don't want to make people sell this thing too, actually. And so you can see up here, there's like the giant red candles. These are leverage unwinds. So people are just like repaying, then selling, and repaying and selling. But what's happening, it just keeps getting eaten up because there's actually more, was it 20x? There's more ability for people to buy than there is actually circulating supply to sell. So you see like, there's like huge levered unwinds, but like it just gets eaten up right away. And but I'm not saying like there's no risk in the system. The risk is actually in the premiums up here, right? But it's just interesting that like we're still like discovering how these market dynamics work.
Yeah, it's a completely new market.
Yeah.
One thing that we find that's like actually really interesting is, so if you think about the efficiency of your loan, it's the difference between the market price and the floor price. So if you have if the price is $5 but the floor price is $4, you're getting 80% of your loan back. Every time you loop that, you're getting 80%, 80%, 80%. So in an infinite series, it comes out to some like it converges towards some like X leverage, right? When you loop at lower premiums, the LTV goes up and the available leverage in the system increases. So it gets harder and harder to push the price down towards the floor because the compression of the premium brings up capital efficiency in the system. So the system is almost like a shock absorber of liquidity, where it kind of like loads up a spring, and then, as it bounces up, it kind of like unwinds a little bit. And if you're trading or you're thinking about, trading these types of assets, the thing you consider isn't like, okay, what is the price and what do we think the price is going to be and what's the FDV? All you have to really think about is like, okay, what's the minimum price? How much capital efficiency do I get from participating in the system? And, what is the kind of like risk premium that I think, is too high and that I should be selling at? Yeah.
That's it.
That's it.
Oh, we have some cool graphics.
Yeah. Yeah. Shout out to our like really awesome designer, Pillhead, who like makes these amazing pieces of art. Yeah.
Yeah. So I just want to say like what we're building next. So currently we launched Yes. There's a lot of learnings with that, and so we're currently working next on the Launchpad, so that anyone can be able to create their own baseline tokens as they want. That's currently going to be in audit soon, and it'll be out soon, hopefully. And here's our socials if you guys want to follow along.
Thank you. We do have maybe 2 minutes for questions if anyone has anything they want to ask Baseline. We've got 2 questions, so we'll do that one first and then we'll have you ask yours.
Can you hear me?
Yeah, that's better.
Yeah, it was really great presentation. Thank you so much. I've known your project actually. Yesterday we talked about it, but actually I didn't realize that this is that project. Your project was kind of very viral in Blast in the beginning.
Yeah.
As a concept ERC 4220, right?
Yeah.
Can you explain a little bit about the relations? What is the ERC 420?
Sure. Yeah. Okay. So just to clarify, ERC 420 is a joke. It's mostly just a meme. It was for marketing because we saw like ERC 404 and people were talking, what was a real standard for us. So 420 just alludes to the fact that the price just keeps getting higher. But it's a meme. It's a meme. The price, there's fluctuations obviously based on the baseline value. But what we're trying to highlight, actually, the reason why we alluded to that, well, 2 things. One is we wanted to make sure people weren't, taking this too seriously. It is an experiment after all. It's the first of many, and it's the first time that we've ever seen any token like this. So, we know there's going to be potential issues or things like that. So we don't want to say, hey, this is like official coin. It's a meme coin. It's like 420 or something. The second thing is the standard. And I think it's really important for us that, the reason we build this isn't just because we want to launch tokens, but because we want all tokens to be like this. If you have Yes in your portfolio, no matter what the price is doing, you always have the liquidity available to do other things you want in it. So if you don't want to loop, another strategy is that you can hold it in your wallet and you can borrow the ETH against it and you can LP it for yield or farm or do other things. And to me, if you have a portfolio of assets like that, where you know exactly what your guaranteed floor is for, all of your holdings, and you have extreme capital efficiency, I think that is a kind of like standard that we should be moving towards. And the other thing about these tokens is because they're all managed by the smart contracts, they're not ruggable. Devs can't just mint themselves new tokens and dump in the market. So they're much more secure. They're much more, protective of the capital, and they're much more rewarding for long-term participants. Yeah.
Thank you.
Yeah.
All right. Thank you very much. I think we'll move on to the next panel. Thank you, Baseline. Give another round of applause.
Thank you, guys.